Welcome to Bit by Bitcoin. It's your host, Dylan Loomis. So there's a huge debate around Bitcoin and if it has any true correlations, and this is to be expected because Bitcoin's only been around for 12 years, so there's not a whole lot of data to go off of, and it's tough to tell what's correlation versus causation. And many people refer to Bitcoin as digital gold, and this is good for beginners and to help people understand what it is generally speaking, but this begins to break down quickly. But more importantly, Bitcoin is way more than just digital gold, so we need to keep that in mind. Part of the problem with this is that so many people will say, oh, the Fed's printing so much money, it's going to lead to inflation, and inflation will cause the US dollar to weaken, and because the US dollar is weakening, people will move money into gold, and because Bitcoin is the new and better gold, Bitcoin's going to go to the moon. And so this isn't completely wrong. The problem is we need to nuance this out far more than just that statement alone. So my goal with this episode is to help you understand the nuanced version of this relationship between inflation and Bitcoin, because it is massively important given the historically high levels of money printing that the Fed has been doing. Here's the one statistic you need to know. It's true that the US government has printed 26% of the entire US monetary supply in 1 year. The M2 money supply is things like checking, savings, money markets, and all of the money in circulation. This figure was $15 trillion in November of 2019. Fast forward 1 year to November 2020, that number hit 19 trillion. So the Fed printed $4 trillion in the span of 12 months. So if you've been wondering why the stock market's up, real estate's up, the sports card market is up, Bitcoin is up, basically all of these assets are up while the economy itself is struggling and going through a pandemic, well, you have part of your answer. So to break this down, there are actually 3 different types of inflation, all very different. You have monetary inflation, you have asset price inflation, and you have CPI, or the Consumer Price Index. Monetary inflation is just what I described. It's when the government decides to print more money to create it out of thin air, which they can do, by the way, at any time and have been doing at historically high levels. Asset price inflation is exactly what it sounds like. It's when the price of assets goes up. Things like stocks, bonds, real estate, gold, collectibles, sports cards, etc. This can actually be thought of as a CPI for the wealthy because it's typically the wealthy or the upper class that actually owns these assets that tend to appreciate in value in the long run. And then you have the CPI, or the Consumer Price Index, which is typically what people refer to when they're talking about inflation in general. It's just a basket of goods that people put a price tag on and they track it over time. There's a major flaw with this though, in that if you think about this one basket of goods, you can't ever make that work because a basket of goods for somebody in Beverly Hills will be very different than someone living in poverty somewhere. Those two people are not buying any same basket of goods. So at best, it is just an estimate. But one main takeaway that's critically important from this video is that something that cost $10 in 1913 will cost you $260 today. To put another way, the value of the US dollar, or the purchasing power of $1, has gone down 95% over the past 100 years. So the next time you talk about inflation, make sure you know what type you're referring to. But to simplify things a little bit, think about when interest rates are low, which they are right now. They're historically low. People look for places to put their money other than checking and savings accounts because they're paying basically zero. So if you're smart and you have extra money that you don't need to pay your bills with, you want to put it into an asset that will appreciate or pay you interest over time. And a quick rant on this, the system really is broken. The wealth gap and disparity in the US is as bad as it's ever been. This is partially why I'm so bullish on Bitcoin. It's an opportunity for the bottom 50% of the world in terms of wealth to flip the script and start saving and growing their money, taking control back from the game the government is playing. Wages in the US have stagnated for the middle class as jobs have been shipped overseas and technology is replacing basically everything. Tax laws have favored massive corporations where I pay more in taxes than Amazon. The cost of healthcare, childcare, and tuition continue to skyrocket, which keeps the bottom 50% living paycheck to paycheck, owning no assets. All the while, the rich get richer because they're the ones that own the assets that appreciate in value. Add to this, the CEO pay has gone from about 20 times that of the average worker back in the 1960s to 200 times as much as the average worker today. And look, I promise you, I'm not a Democrat. I don't do politics. I just see facts as facts, and the government is doing the middle and the low class very dirty. They're doing them zero favors. Bitcoin is the way out. And there's 2 important disclaimers here. The correlation of Bitcoin really depends on whether it's in a bull run or a consolidation phase. and it's a bit beyond the scope of this episode, so we'll save that for a future video. And it's important to remember too that there are far more factors than just inflation that cause price movements in Bitcoin, so always keep that in mind. This video is just focusing on one relationship, that being inflation, the devaluation of the US dollar, and real interest rates. So this brings us to gold, which has had a very strong correlation to real interest rates. And real interest rates are basically just adjusted for inflation. So if a bond's paying you 5% and inflation is 2%, your real interest rate or real return would be 3%. Whenever real rates go lower, gold tends to spike in price. When real rates go up, the gold price usually goes down. It makes sense too, because if interest rates are paying you 0% or negative, meaning inflation is higher than your yield, people will move money from bonds into gold. When interest rates then go up, offering better yields, people will leave gold and move back into bonds. And this matters for us today because given where the US government is in their long-term debt cycle and given the current trends of the US dollar being devalued, we're likely to experience negative real yields for quite some time. And add to this the fact that the Fed has said they don't plan to raise interest rates until 2023 or later, and we can expect to see an environment where this excess money being printed is looking for a home to generate returns. So in the short term, Bitcoin's price will most likely be affected by stimulus outcomes, as this will shift the inflation expectations and the real yields. Thus, it could be an inflation hedge like stocks, because if people are expecting the price of assets to go up, they will buy more now. It's also super important to mention the halving periods for Bitcoin that act as fundamental catalysts in the long run. Every 4 years, the new supply of Bitcoin gets cut in half and the demand usually remains strong. This creates very strong price momentum upward due to the basic supply and demand relationship. So these halving periods have created strong run-ups in price, and we can expect this to continue, followed by a consolidation period after. And one other thing to note here, many people are shouting about hyperinflation coming for the US. In my opinion, I'd say to slow down with this because the US dollar is the global reserve currency, meaning that the US can get away with a lot more than other countries like Venezuela. Basically, certain things like oil and energy are priced in US dollars, and sovereign debt is also in US dollars, which creates a demand floor that other currencies just don't have. It's going to take a lot longer for the US to reach hyperinflation and to get out of control. So to wrap things up, we're in a much different Bitcoin bull market now than we were in years past. The fundamentals are different, the technology and security is better, the network effect is better, stronger hands are actually holding Bitcoin like institutions, corporations, and pension funds, and the printing of money will drive up demand for fixed quantity assets like Bitcoin. And when it comes to Bitcoin and inflation, it's too early to have strong empirical data, but in a world where real interest rates are low and the dollar is being devalued by money printing, it creates a very strong case for the scarcity of Bitcoin as an inflation hedge at the very least. But that's all I have for you guys today. Please like the video if you did. Consider subscribing for more Bitcoin content. And with that, I look forward to seeing you in the next video. I hope that you have a great day. Earning one being that correlates. People are going to look for